We've received a lot of questions about the different things that are going on in the world. The trade tariffs, the macroeconomic challenges that are going on in the Middle East and with Ukraine and Russia, and just the changes economically around the globe. And we will do a separate video to address that, because even as we talk about target returns, the question people have had is, with everything going on, how is that affecting your performance? We'll look at that as a separate video. But for now, let's go into our returns and how did we do. So quarter one, our absolute return for the quarter, for the 3 months, was 4.66%. And that return, when you annualize it, works out to about 18.64%. So let me just stay there for a moment, and I want Ian to come in and sort of just break down, when you say absolute return, what does that mean versus annualized return?
Okay. Before I go to absolute and annualized, I want to break it down to, there are two returns that we'll always report. There is the client's return, and there is the fund return.
That's right.
If what we usually share is at fund level, what is the return? So assuming at the beginning of the year, we only had one client who is the fund, and they had, let's say, 1 million, they would actually have 46,600 as their absolute return. That is the profit that they have, or the income that they have in their statement, if that was one. However, so if the same return was replicated for the second, third, and fourth quarter, we'll end up with 18.64%. And by the time we reach 18.64%, we are not compounding. We are assuming that it's straight line, that is the same return that's being given on quarter on quarter. However, there is what the individual clients get. When we calculate the fund return, which is guided by the principles and the regulations of Capital Markets Authority, there is what we call a dilution effect, whereby the profit is usually over the total starting, I want to call it AUM, plus any deposits that were there.
AUM, assets under management.
Assets under management, plus any deposits that are there. So it ends up reflecting a lower figure than what some of the clients will actually get on their statements.
But some get higher, some get lower, depending on when you come in.
Yes.
So, and this is so important to talk about, because the reality is, if someone comes in at the end of the quarter,
yes,
like this happened this quarter, where at the end of the quarter, we get a client signing up on the 26th of March.
Yes.
And then our dear, this global environment happened as they did. And those 3 days towards the end of the quarter was just very interesting. We saw a lot of stocks coming down, yields of bonds going up globally, right? So that then, if you come in on the 27th, there's an impact that is felt, and your returns will not be the same as the person who began January 1st of the year. And that's what really you're talking about. The fact
True.
And then also, as more people bring money to the fund and the fund grows, then even returns are spread over more people. So did the fund make the return? Yes. But depending on when you came in, the fund return for you may be higher than what we're reporting, or slightly lower than what we're reporting.
True. Thank you for that. Just to bring it to light, like if you look at March itself, the whole of March, from a fund perspective level, we actually had a return of 15.25%.
That's annualized.
Annualized for March alone.
Yeah.
However, for clients who are there the whole month, if you look at their income versus what they had, and they had no top-ups, they actually had 16.94%. Yeah. So as much as we give the annualized and the absolute return for the fund, it's a guideline of where we are. Individual returns may differ slightly, either higher or lower, from where you'll find the return on the fact sheet. And this is very important because we have had a few clients ask that question. To add on to that, and that's why we have on our fact sheet, there is what we've written as a simulation. Kenya shilling 1 million invested in 1st of January 2025 would have yielded 48,314.49 by the end of the first quarter. If you look at that, actually, in a percentage way, you'll say this is an actual return of 4.83%, while the fund actually, based on the calculations we've been guided by the Capital Markets Authority, has an absolute return of 4.6. So these are a clear case of showing you how the client return may differ from the fund return.
Yeah, thanks for that.
Yes.
So in comparison to last year, 2024, we did an annualized return. I'm sorry, not even annualized. Absolute, meaning from February to December, our return was 29.38%. This year, however, so far, annualized for the first 3 months is 18, but absolute is 4.66%. So in terms of how we allocate when funds come in.
Allow me to stress on one point.
Sure.
I've seen several of our clients asking, last year you started the fund in February.
Yeah.
Are you closing the year in February? Oh. And I believe you are the best suited to explain that.
So the fund runs from January to December. It's just that last year we began in February and closed in December. But our financial year for the fund is January to December. And so this year we're not closing in February. We have begun January as the beginning of the year, and we'll go until December. So our last year, yes, it's short by 1 month.
Yes.
Yeah.
And just to stress on that, companies that are regulated by Capital Markets Authority are required to have their financial years starting from January and closing in December, similar to companies that are regulated by Central Bank of Kenya. So it's more of a regulation rather than a preference thing that we have to close our years in December every time. Thank you.
Thank you for that, Ian. I think really important for us to note. So yeah, January to December. Okay, so let's move on with the fact sheets. The next, just still on the same first page, we have asset classes. So asset classes is just a fancy name to group different financial assets into certain classes or certain groupings based on features that are common within those products. So products that are cash and near cash, meaning that you can liquidate or sell and get your cash quickly, are called cash and cash equivalents. Then you've got those that where you're buying a company and you are becoming a part owner in that company, those are called equities or stocks. And then you've got those ones that have fixed income. You know, they pay, it's like an IOU, you lend them money, they borrow money from you, and they promise to pay you back at a certain time. Those are common features. They're called fixed income securities. So that's why we call them asset classes. It's just a convenient way of grouping them so that in the decision making around investing, then we're able to figure out how are we distributing the money. So Oak Special Fund has a team of traders and dealers who specialize in different asset classes based on their expertise. But we also have an investment committee that sits every month to give guidance and insights based on their expertise around what's happening around the world. And we sit down and we evaluate and we debate and we discuss and agree on a strategy that is within our policy. We have an investment policy document that guides what we as a fund are and are not allowed to invest in. But based on that and what's going on globally, then we make decisions around what are the asset classes we're going to invest in. So the strategy for 2024 is not going to be the strategy for 2025. Sure. It's based on what is the opportunity, how is it working. But you know, you're the head of that team. So let me hand over to you and just sort of look at what are some of the asset classes that you're finding that you invested in that were perhaps a little different or, you know, for Q1, and where did we get return from?
Okay. I'll say one of the major things that has happened is the drastic drop of interest rates locally. We've seen that globally also happen. And if you look at asset allocation within, let's say last year from November towards March was mostly concentrated on the fixed income area, where fixed income, we're talking about local government bonds that are offered by the Kenyan government. And the major issue was with rates dropping. There's what we call mark-to-market or capital gains. So you buy at high yields, but yields are falling, and based on mark-to-market or even straight out selling those bonds, you are able to get what is called capital gains.
So let me pause you for a second, because there are a few terms there that, yield meaning, so yield, let me translate our chief investment officer's terminology. Yield just means interest or return.
Yes.
So, for example, last year in February, there was a bond, an infrastructure bond that was issued at 18.4%.
Yes.
Tax-free. That same bond today is at 13 point, I think it was 0.8, 13.6, around there. 13.
Yes.
Can you imagine that last year, a year ago, it was 18.4. Today, it's 13.8. So you see that difference. And what he's saying is that when yields have come down, or when interest rates come down, if you're holding that bond that is at 18.4 and it comes down to 13, you're in the money.
Yes.
Like there's a return to be made, and we call those returns capital gains. So the value of your bond grows when interest rates come down. And so that's how we were able to make returns from the bond. Sorry, let me hand it back over.
Thank you for saying that, because majority, let me say, and we are trying to break it down for the non-financial person or someone who's not in the financial industry to understand.
Yeah.
Because the question is asked, 60% or 70% of your assets are in bonds.
Yes.
They can look at the newspaper and see that these bonds are basically at, let me call it an interest rate for the sake of understanding, of 15%. But you are aiming to deliver 20%.
How?
Where will you get the extra? Because majority of them will take 15%. They say there's a management fee of 6%. So you are left with 9%. How can you deliver 20%? But how the capital gains come about is beyond the interest or the yield that you see on that paper. And if I may give a vague example, you are saying that there is an instrument already that is in the market that is willing to give, let's say, 18%. But market has dropped to a lower level. Having dropped to a lower level, people are willing to pay more than the worth of that paper. So if it was being sold at 100 bob, people are willing to pay 120 shillings. So they are paying more than its value to get it because it has better cash flows than what is being offered in the market. And that is where the capital gains come. And on such sales, you can find that people are able to get something above 20 to even 30, and sometimes for short-lived papers, you can even make 40-45% annualized on 2-3 weeks trading.
Wow. Yeah.
And that is where we make our money.
We made
our money. Thank you.
Because we don't know what's going to happen in the next few weeks, right? So,
True.
So I want us to stop there and take a breather so that you can absorb what we have just shared. If you've never invested in Oak Special Fund, we're happy to answer your questions. There's a number on the screen. Just type a WhatsApp message to that number and we will assist you, even if it's just information that you want as you process. So thank you so much. You're watching Oak. Thank you so much. You are watching Oak Special Fund. My name is Rina Hicks and I'm joined by Kahangara, our Head of Global Markets, and we will be right back.